We're talking about inventory, but we can't understand how to record inventory unless we understand credit terms. INV-2. When companies sell on account, also called for credit, they provide credit terms indicating when payment is required. Common credit terms may be 110, net 30, or 25, net 15. What do credit terms mean? The best way to show what credit terms mean is to do a timeline. In order to do that, I need to have some kind of credit terms. So let's do. What does this mean? It means that in 10 days' time, if payment is either made or received, the payer can take a 2% discount. If the payer does not pay within 10 days, then they must pay within 30 days the net or full amount. 210 net 30. Now, let's do a timeline. Let's assume the freight terms are FOB destination and we receive the inventory on January 3rd. Ownership will transfer on January 3rd from the shipper to us, the receiver. The cost of the inventory is $10,000. Because of our credit terms, we have 10 days to pay and get a 2% discount. When did we receive the inventory? How many days do we have? In that case, we have until midnight on January 13th to pay and take the 2% discount. If I pay within 10 days, I won't pay the $10,000. Instead, I'm going to pay 98% of the $10,000. In fact, I'm going to pay $9,800. My $10,000 accounts payable will be settled by me paying $9,800. Now, what if I decide not to take the discount? I'm short on cash right now, and I'm going to wait the full 30 days. When do I have to pay by? My lovely little trick from previous really doesn't help me because this is 33 and there's no such thing as January 33rd. But I know there's January 31st. And if I add 2 additional days, that's 33. So now I know that I have to pay by February 2nd. If I pay between day 11 and day 30, I have to pay 100% of the invoice. That means I'm going to pay the full $10,000. What's going to happen if I don't pay by February 2nd? Beyond midnight on February 2nd, the supplier is going to start adding interest to my account. Why would a supplier do that? Because the supplier has given up their inventory and not received any cash inflow. The supplier is sitting there waiting for you to pay. And as a consequence, the supplier might have to borrow money from the bank in order to pay cash on their expenses. So if you don't pay within the credit terms, they're going to start dinging you with interest because you are negatively impacting their business. Let's do one more example of credit terms. Let's assume credit terms of 115 and net 25. The shipping terms were FOB shipping point, so ownership transferred on April 10th, as soon as it left the shipper's doors. The invoice amount is $6,000. What is the last date when the receiver can still take a discount? The receiver can take the discount up until midnight, April 25th. How much will the receiver pay? $6,000 times 100% minus 1%, $6,000 times 99% is equal to $5,940. In order to settle the outstanding account, the receiver only has to pay $5,944, not the $6,000 that they owe. By what date does the buyer have to pay in full? April, unfortunately, doesn't have 35 days. It only has 30. But the 5 days would be in May. The receiver has to pay the whole amount outstanding. And the whole amount outstanding is the full $6,000 by May 5th. What if the receiver doesn't pay by May 5th? After midnight on May 5th, they're going to start being charged by their supplier. Now that we have a full understanding of both shipping terms and credit terms, we're going to do some entries into a perpetual inventory system. And that will be in the next video.